Okay, picture this. A financial earthquake hits. But there are no blaring sirens, right? No dramatic news alerts breaking into your TV show. Just this silent, terrifying realization rippling across computer screens worldwide. Welcome to today's Explainer. We're not doing your standard run-of-the-mill market recap today. Instead, we're diving into a chilling, almost cinematic what-if scenario from our source material. What if Wall Street completely crashed on the single most anticipated evening of the quarter, tech earnings night?
Number 1. The initial crack. The very first sign of this hypothetical catastrophe wouldn't be loud. It wouldn't be obvious. Honestly, it would just be one number, falling just a little too fast during after-hours trading.
So, analysts are ready, hedge funds are braced, and millions of everyday investors are just staring at their phones, right? Hoping the market gives them a reason to feel smart. But instead, the floor just disappears. As our source material so starkly puts it, Wall Street would not just fall. It would crack. And once that crack began, it would spread through the entire financial system like glass under pressure. I mean, wow, that perfectly illustrates that we aren't talking about a clean, orderly drop here. This is a violent wave of disbelief, systematically shattering the illusion of endless tech growth that the entire market has basically been leaning on. At first, human nature takes over and what we call the comforting lies kick in. A giant tech platform misses its revenue targets? Oh, it's just consumer softness. Another one gives weak guidance? Obviously just some enterprise spending delays. Or maybe it's higher borrowing costs, massive AI infrastructure expenses, slower ad demand. We tell ourselves literally whatever we need to hear to make it okay. But here is the massive danger. Markets don't react to these reports in isolation. They react to the story those earnings tell together. And if that combined story screams that growth is crashing, well, the mood goes from optimistic to absolutely terrified in a single evening.
Suddenly, the whole tone changes. The market starts behaving like it seems something it just cannot unsee. Picture the after-hours trading screen turning this deep, dark red as one major stock plunges, and then it's immediately followed by another. We're talking well-known names losing billions in market value in mere minutes. The financial media starts throwing around words like turbulence and unsettling, which, let's be real, is just their polite way of avoiding the word panic. The isolated misses suddenly coalesce into this terrifying reality.
So why does it spread so incredibly fast? Well, because modern Wall Street is not built like the old one. It is highly connected, it's emotionally synchronized, and it is lightning fast. It's totally driven by algorithms and momentum, and it's heavily concentrated in just a few tech indices. Think about it. The exact same system that amplified the ride all the way up is perfectly designed to amplify the ride on the way down. Algorithms notice the weakness, risk managers instantly tighten their positions, and boom, a sector problem instantly becomes a massive market-wide psychological event. Let's look at the hidden machinery driving the crash, the dreaded margin call. This happens when traders are forced to sell assets, not because they want to, but because they absolutely have to in order to cover leveraged positions as prices rapidly fall. This creates a completely ruthless feedback loop with zero sympathy. Forced selling pushes prices down, which, of course, triggers even more forced selling. Suddenly, everyone is looking around asking if the liquidity that looked so incredibly robust at the top was actually just an illusion built on borrowed money. And then, the contagion literally spreads across the globe in a matter of hours. It starts in the after-hour session in New York, where emotion always gets a head start on reason, and fear becomes very, very real. By the time the Asian market opens, foreign markets take one look at Wall Street and panic. Fund managers worldwide are frantically checking their exposure and cash levels. And by the next morning, the damage is completely global. Wall Street goes into full survival mode, running all-hands calls and desperately trying to prevent panic from turning into a full-blown stampede. Now, crucially, this kind of financial trauma doesn't hit everyone all at once. It rolls out in a staggered emotional pattern. First, active investors and day traders take the immediate brutal hit. Next, the 401k crowd wakes up to see their so-called broad index exposure wasn't nearly as diversified as they thought. Then, tech employees have to sit there and watch their stock-based compensation vanish faster than their calendars can process. And finally, it hits the wider public on Main Street. Because as we know, Wall Street always eventually leaks right into the real world. Just picture the tech CEOs trying to manage this live on their earnings calls. Their corporate language becomes a literal battlefield of perception. If they sound defensive, the market punishes them. If they are too cheerful, they look dangerously out of touch. If they sound cautious, investors read it as a flashing red warning sign. And if they lower guidance, well, they validate the entire crash. On a night like this, the earnings call stops being simple financial report. Every single pause, every carefully chosen phrase is dissected and used as fuel for the next wave of selling. The psychological toll of this scenario really cannot be overstated.
It would feel like the future itself got hit. For years now, tech stocks haven't just been companies. They've been the market's invincible engine. They represent cloud computing, AI, automation, basically the fundamental belief that technology will just keep carrying the broader market upward. People don't just own these stocks, they deeply believe in them. So when that belief is shaken all at once, the crash becomes deeply symbolic. It challenges our shared identity and our confidence in tomorrow.
And when Wall Street breaks, Main Street freezes. Consumer confidence weakens almost immediately. People delay luxury purchases, businesses rethink new hires, and postpone major capital spending. Even startups feel the chill as venture capital gets highly defensive. You see, tech isn't just a stock market story. It's a capital allocation story that decides which version of the future actually gets financed. If that engine stalls, the optimism powering real-world innovation stalls right along with it.
As the dust finally settles and wealth evaporates, policymakers and central bankers would be forced to step in and ask some highly uncomfortable questions. Like, is the market just too concentrated? Are regular households way too exposed to just one single sector? These are the tough, structural questions that society is perfectly happy to ignore when prices are going to the moon. But crashes create policy openings. They force us to confront the vulnerabilities and systemic fragilities we were totally turning a blind eye to during the boom times. We really need to slow down here for a second and consider the deepest consequence of this scenario. A crash of this magnitude wouldn't just be a simple correction that shaves a little froth off the top of the market. It would fundamentally change the price of belief. It forces a total reassessment of what future expectations are actually worth. A tech giant that once seemed absolutely destined to rule the future can suddenly be treated like an ordinary business dealing with extraordinary uncertainty. We're talking about a total regime change in valuation.
But what if the crash is actually a much-needed reset? Think about it. A crash heavily punishes companies built on pure hype, those relying on excitement, momentum, just great stories, and the assumption of endless upside. But on the flip side, companies built on reality, those with real cash flow, real margins, real demand, and strict corporate discipline, they eventually emerge even stronger. The era of easy assumptions comes to a screeching halt, and progress becomes far less forgiving of empty promises. Our source material sums this up with a truly profound thought. Sometimes a crash is not the death of a story. Sometimes it is the moment the market starts telling the truth again. That just perfectly captures the painful but potentially transformative nature of an event like this. The truth is always expensive when it arrives late, but a crash can be the exact moment the market finally stops rewarding fairy tales and actually demands durability, clarity, and actual profits. So what does this all mean? We're left with this final, haunting question to consider. In the aftermath of this cinematic what-if, you really have to look at the market and ask yourself, was it a resilient system that just hit a temporary wall? Or was it a fragile structure, propped up by pure excitement until one really bad earnings night revealed the entire truth? This scenario exposes years of hidden assumptions about technology, growth, and the true price of the future. Thank you so much for joining me for this explainer, and I highly encourage you to take a close, really honest look at the hidden assumptions in your own portfolio today.